Welcome to our module on inventory. Let's get started. Inventory is defined as an asset that's purchased or built for the purpose of reselling to customers. Inventory includes items that are held for sale in a grocery store, items that are being produced for sale to customers, items that have been completed in the production process and are available for sale to customers, items in a large warehouse that are available to customers, and even automobiles that are on a dealership lot that are held for the purpose of selling to customers. The operating cycle is important in a business, and it is defined as the amount of time that it takes for cash to leave the business to purchase inventory, and then that inventory sold to customers, and the customers ultimately return cash to the business. So an operating cycle is the amount of time that it takes from the cash leaving the business to purchase inventory to the cash coming back into the business from the sale of the inventory. A merchandising company has inventory, and what is unique about a merchandising company is that inventory is purchased in ready-to-sell condition. Examples of merchandisers are Walmart, Macy's, Home Depot, and a car dealership. We can also have a merchandiser that is just a simple produce stand. All of these companies have one thing in common: they purchase their inventory in ready-to-sell condition. Manufacturing companies, on the other hand, build the inventory. They buy component parts, assemble those parts into an item that they sell to customers. Examples of manufacturers are General Motors, IBM, and Sony. All of these businesses buy component parts, put them together, and build their inventory that they sell to their customers. The accounting associated with manufacturing companies is far too complicated for us to address in this course. Therefore, we need to understand what a manufacturing company is, but we will not be studying accounting for manufacturing companies' inventory during this course. The economic events related to inventory that we will study, and remember, we'll study it only for merchandising companies, are purchasing inventory from a supplier, receiving a discount from the supplier, paying for shipping from the supplier, returning inventory to the supplier, paying the supplier for inventory. Then we will study selling inventory to the customer, paying for shipping to the customer, giving a discount to the customer, and receiving inventory return from the customer, as well as receiving a payment from the customer. Finally, we have something called shrinkage that we'll study at the end. There are two different types of accounting systems that we can use for inventory. The first is perpetual. In a perpetual system, the inventory account is updated whenever inventory is purchased and when inventory is sold. A perpetual system provides more detailed information and is generally more costly than the alternative system. It is the preferred method because it does give more information, but because it is more costly, it may not be cost effective in all businesses. Examples of businesses that will most likely use a perpetual system would be any business such as a diamond or jewelry broker that has very expensive inventory items. In addition, even if the items aren't expensive, if there's a computerized scanning system, the company may be able to use the more advantageous perpetual system. The alternative to the perpetual system is the periodic system. The periodic system only updates the inventory account at the end of each accounting period. Accordingly, it provides less information than a perpetual system. However, it's useful when keeping detailed records on specific items sold is not cost effective. An example of a business that would use a periodic system might be a street vendor. A street vendor has many different low-cost items, but does not have a computerized accounting system to keep detailed records as to which specific item is sold. So in review, we learned that inventory includes assets that are held for resale to our customers. Merchandisers are those that buy inventory in ready to sell condition, and manufacturers build their inventory. Again, we're not going to study the accounting for inventory for manufacturers in this course. The operating cycle is the time that it takes for cash to leave the business to purchase inventory to cash to return to the business from the sale of inventory. Economic events related to inventory we'll study in more detail in subsequent modules, and accounting can be done with a perpetual system or a periodic system. That wraps up our introduction to inventory. Our next module will start to look at the economic events related to inventory using a perpetual system.